Study Section 12. Foreign Reserves and International Banks. Introduction. Why should a country hold reserve? Where do foreign reserves come from? What do countries use reserve for? What is the implication of reserve depletion or accumulation? In the 2000s, the monetary authorities advised the government that part of the foreign inflows from crude oil should be converted to reserve. Why this advice? Foreign reserves serve the same purpose as private reserve. Recall that private individuals keep in reserve part of his income in order to prepare for the rainy day. In particular, transactions are carried out on daily basis while income is earned once in a month. How will salary earners use the salary to take care of his daily transactions? At the day of receiving the salary, individual salary earners will be very rich because money income will be very high. But when they enter the second or third week, money income reduces. What happens to expenditure? Well, perhaps reduces as well, or at best, non-increasing. To keep transactions stable while income falls, private rational individuals will want to hold an average cash that will keep him going until the next payment. As individuals hold cash to meet up with differences in expenditure and income, so also a country holds reserve to finance balance of payment disequilibrium. Note that when monetary outflow is less than monetary inflow, implying that international expenditure is more than received, reserves are used to fill the gap to finance the deficit. Thus, reserves are used to cushion the effect of short-term current account deficit until proper adjustment mechanism is made. If a country holds reserves, current account deficit can be temporarily offset while authorities are deciding on appropriate policy to permanently address the problem. Again, if reserve is too large, it makes the authority relax and not think of policy measure to address deficit, and this may cause problem. In this chapter, we shall learn how reserves are determined and the role it plays in the economy. We then examine the reserve position of Nigeria since 2005. The chapter also discusses the function of international banks and the risks they face. Objectives of the study. At the end of this lecture, you must be able to do the following. Identify the determinants of reserves. Understand the components of reserve. Appreciate the use of reserves. Explain the reserve position of Nigeria. Investigate various ways of borrowing reserves. Understand the role of international financial institutions. Explain the risk international banks face in lending to firms from other countries. Demand for international reserves. One major role played by international reserve or simply reserve is that it can be used to correct balance of payment disequilibrium. The magnitude and longevity of balance of payment deficit can be sustained in the absence of equilibrating adjustment depends, importantly, on the stock of foreign reserves. There are two factors that determine the demand for reserve. These are the monetary value and size of international transaction and the balance of payment disequilibrium. The institutional framework of the world economy and the speed of balance of payments adjustment are other factors necessitating demand for reserves. Exchange rate flexibility and international reserve. The degree of exchange rate flexibility is one of the determinants of demand for reserves. To make this understandable, let us use a graphical illustration such as figure 12.1, assuming that the exchange rate that establishes equilibrium in the foreign exchange market is ER*, with the corresponding equilibrium volume of currency being N*. Recall that any factor that increases import will lead to demand for foreign currency and hence supply of domestic currency. Thus, the demand curve shifts from D0 to D1. When this is the case, exchange rate will have to rise due to demand for foreign currency and supply of domestic currency. Rising exchange rate means that the exchange rate is depreciating. If the country is operating a fixed exchange rate, the authority will have to intervene by purchasing domestic currency with foreign currency, and this leads to further supply of naira in the foreign exchange market, and so supply curve shifts from S0 to S1. The amount of currency drawn from reserve is equivalent to the amount of naira to be purchased which is given as the difference between N** and N1. For example, if the amount that ascertains initial equilibrium N** is 100 million naira, while the amount that will ascertain new equilibrium N1 is 150 million naira, then the Central Bank of Nigeria will draw down reserve to buy 50 million naira in order to maintain the pegged exchange rate. Assuming that the CBN maintains managed pegged exchange rate, in which case there is a permissible range above which the authorities will have to intervene. Assuming that ER** is still the equilibrium exchange rate, but the authorities will allow exchange rate to respond to changes in demand for or supply of naira up to ER1 before they intervene. Assuming that the market equilibrium ER** exchange rate is 130 per dollar, let us assume that the million, if Nigeria's imports increase to 170 naira equivalent, it means the maximum exchange rate will not be consistent with this volume of naira, and so, that is, naira has to be depreciated more. The CBN will not want naira to depreciate more than 140 per dollar, and so the authorities have to intervene in order to prevent naira from depreciating more than the upper target. To do this, they have to buy 10 million naira equivalents of dollar, and this will shift the supply curve from S0 to S2. Note that as the CBN relaxes the exchange rate policy moving from fixed to floating, demand for reserve is also reducing. Now consider a case in which the authorities embark on flexible exchange rate. Clearly, there will be no need for demand for reserves because the system will automatically adjust to equilibrium. The implication of this is macroeconomic variables and international reserves. Another important determination of foreign reserves is the situation of the automatic adjustment mechanism that needs to take place when there is balance of payment disequilibrium. Recall that under the monetary approach to balance of payments and the absorption approach, we point out that factors such as price level, interest rate, income level, and monetary stock play major roles in balance of payment disequilibrium. Now, if these variables reflect their fundamentals always, if there is no distortion, that is, if they operate in a perfectly competitive market, balance of payment will be self-correcting anytime there is a disequilibrium caused by any of these variables, because market forces will restore equilibrium in all the markets. Thus, in a nation where all macroeconomic variables work perfectly, a free market situation, there is no need for reserve holding. But if any of these factors is distorted or regulated, it follows that it will not respond quickly to disequilibrium, and so there is the need to determine for reserves to correct the imbalances. In particular, if macroeconomic variables respond quickly to balance of payment disequilibrium, there will be no need for reserves. If they respond slowly, there will be need for reserves. Hence, reserve has an inverse relationship with the market situation of an economy. The efficient the markets are, the less reserves are needed, and the less efficient they are, the more reserves are needed. Government trade policies and international reserves. The third factor that determines demand for reserve is government policies, as it affects balance of payment. If government policies used to correct balance of payment are very effective, reserves may not be needed. Such government policies include import tariffs, import-export quota export subsidies, and other trade policies. All these variables require political decision, and of course, the extent to which they command political backing, the easier it becomes to implement. If government gains political backings on the use of these policies to correct imbalances, government can impose high tariff, give more export subsidies, then there will be less dependence on reserves. But government cannot gain public support, Then reserves will have to be demanded for to correct the deficit. Meanwhile, if government gains political support, it does not mean that the policies will correct the imbalances. For the policies to correct the imbalances, it must be reasonable, effective, and efficient. Note that there is a strong argument against the use of high tariff by small countries. Thus, if a small country increases tariff, import may not likely fall and purchasing power may fall, and this may also worsen current account position. What this means is that there is also an inverse relation between reserves and government trade policy. What price and income? When world price increases, the value of international transaction will increase, and this will lead to balance of payment disequilibrium, which will then require demand for reserves to do adequate adjustment. For example, if the world oil price rises, countries such as the US and other advanced countries that consume fuel in large quantity will experience high cost of production and by implication, high price level. The high price level will raise the value of international transaction, which will then necessitate demand for reserve to correct any imbalances. It follows that from demand side, reserves are needed to make up for possible or expected excess payments to other nations. The quantity demanded for international reserve is directly related to the size and duration of the payment gaps. If a country is willing and able to establish policies effectively, increase receipt inflow or reduce payment outflow, reserve will be needed in small quantity. If a nation initiates not action or the actions are ineffective, reserves will substitute for the incapability of government not to effectively enact good policies that will correct balance of payments disequilibrium. Supply of international reserves. Apart from factors necessitating demand for reserves, there are factors responsible for supply of reserves. Reserves of a country can be classified into two: own reserves and borrowed reserves. Owned reserves are the ones accumulated by the country resulting from its inflows. Borrowed reserves are the ones borrowed from the international fund to correct imbalances in the balance of payments when owned resources cannot completely offset the imbalances. This is not to say that the entire owned resources cannot offset the imbalances, but that the owned resources cannot be drawn below a certain minimum acceptable level. Owned reserves include gold, acceptable foreign currencies such as US dollars, British pound, European euro, and Japanese yen. Borrowed reserve can be got through nations with excess reserves, foreign financial institutions, or international agencies. Foreign currencies. International reserves are means of payment during international transactions. The holding of national currency is one of such assets. Other currencies generally acceptable for international transactions are the British pound, the US dollar, the Japanese yen, and the European euro. The reason for using British pound as means of international settlement is the role played by pound in the 19th and 20th centuries. During this period, the British played dominant role in the world trade, and London was the first foreign exchange in the world. The emergence of the US dollar as a reserve currency stems from the situation of the economy during and after World War II. The economy of the US was not significantly affected by the war because it was very strong. After the war, the US economy waxed stronger than other developed economies, and as a result, the economy witnessed large inflow of gold and by implication became reserve currency even better than the pound. Using dollar as a reserve currency implies that the supply of international currency varied with the payments position of the US. In the recent times, the euro and yen have also become means of international payment due to their strong economic activities and the role played in world trade. Gold. The analysis of reserve will be incomplete if we ignore the role played by gold, even though it is seldom used nowadays as international reserve. Functions performed by gold in the international scene include a unit of account against which commodity prices and national currencies are quoted. And in international means of payment, gold is a store of value even though it does not yield interest rate. Gold is generally acceptable compared with other forms of international monies. In the modern economy, the role and value of gold has dropped dramatically. For example, over 35 years, gold has fallen in value from 70% to around 2% of world reserve. Private individuals do not usually use gold as a means of payment, and the central banks do not usually use gold as an official unit of account. However, most countries in the Middle East still make use of gold as a means of international payment. Nigeria in recent times has ceased to use gold as a means of international payments. Such drawings are not without interest rate. In fact, surplus nations will be paid some interest of the amount drawn, which is the difference between the deficit and the SDRs of the borrowing nation. For example, if the minimum SDRs of Nigeria from its quota is $40 million, and if the country needs, say, $60 million to service or offset deficit, it cannot draw more than $40 million. So, it has to borrow $20 million from a country member with surplus foreign reserve. Nigeria will then pay interest on the $20 million borrowed. Conversely, if Nigeria is the surplus country, any country with deficit can borrow from Nigeria's reserve and pay interest. The interest is reviewed and adjusted quarterly based on the interest rate of the United States, the United Kingdom, Japan, Germany, and France. When the SDRs were initially adopted, it was agreed that the value should be maintained at a fixed rate of US per value. After several monetary developments, this arrangement became unacceptable. Under the managed floating exchange rate adopted by developed countries in the early 1970s, SDRs fluctuated notably against other currencies while still being fixed to the dollar value, and this created serious currency problems. In 1974, new SDRs that take into account other international currencies into consideration were initiated, and it is called the SDR's basket valuation. This basket valuation is intended to provide SDR stability in the face of exchange rate fluctuations. It is called basket valuation because it is based on the value of four currencies: dollar, euro, yen, and pound. If the exchange rate in any of the currencies appreciates relative to others in the basket, the value of SDRs will increase. If any of the currencies depreciates relative to others in the basket, the value of SDRs will fall. Borrowed reserves. Having analyzed their components and characteristics of own reserves, we now turn to borrowed reserves. Borrowed reserve actually complement rather than substitute owned reserve in dealing with balance of payments problems. Borrowed reserves provide adequate time for monetary authorities to correct balance of payments disequilibrium. Major sources of borrowed reserves are the IMF, which is called the IMF drawings. We also have the general arrangement to borrow and the swap arrangements. The IMF drawings. One important function of the IMF is to assist member nations to finance balance of payments deficit. The IMF offers temporary loans to deficit nations, and the loans are expected to be paid back within an agreed period of time. How does a country borrow from the IMF? Countries don't actually borrow. If a nation is suffering from balance of payments deficit and wishes to finance it through IMF drawings, the country will sell its domestic currency so as to purchase foreign currency required to offset the payment deficit. When the balance of payments improve, the nation will buy back the domestic currency back from the IMF and pay with foreign currency. Fund allows an intending borrowing nation to purchase foreign currencies at their own option, whether in yen, euro, dollar, or pound, up to 50% of the nation's quota. The quotas are based on the economic size of the member nations. Meanwhile, if there is any case for the deficit nation to purchase foreign currency more than 50% of its quota, the fund will grant permission on the condition that the deficit nation creates reasonable and convincing measures to improve its balance of payments. The General Arrangement to Borrow. In 1962, General Arrangement to Borrow was introduced. This arrangement was introduced by 10 leading economies in the world then, called the Group of 10 G10. They agreed to pull together and lend up to $6 million to any deficit nation in need of foreign currency to deal with international payments problems. The credit arrangement will be used when the deficit nation's borrowing need is more than the amount of assistance that could be provided under the fund's drawing facilities. Nigeria's external reserves position. Nigeria's external reserves are composed of the Central Bank of Nigeria (CBN) reserves, the Federation reserves, and the Federal Government reserves, with CBN having $31.5 billion, representing 73% of the country's total external reserves as at April 2007, while the Federation reserves and the Federal Government reserves are 22% and 5% respectively, figure 12.2. The CBN reserves consist of foreign exchange that have been monetized by the bank and released to the beneficiaries for their use. The bank receives foreign exchange inflows from crude oil sales and other oil revenues on behalf of the government. The proceeds in Naira equivalents are credited to the Federation account and shared each month in accordance with the Constitution and the existing revenue sharing formula. It is from this portion of the reserves that the bank conducts its monetary policy and defends the value of the Naira. The second is the Federation component, which represents the portion of the external reserves that has not been monetized for sharing by the federating unit, that is, the three tiers of the government, namely the federal, state, and local governments. The naira values of such reserves are sterilized in various customer liability accounts and can only be released into the financial system upon receipt of mandate from the beneficiaries. Also, earnings called excess crude oil proceeds, which is the difference between the budgeted benchmark and the actual market price of crude oil, belongs to this component. They also include the differences between budgeted benchmark of petroleum, profit tax PPT, and the actual PPT realized. The third is a component of the external reserves that belongs solely to the Federal Government of Nigeria, FGN. It comprises, among others, foreign exchange realized from the sale of federal government properties, proceeds from the privatization of federal government companies, returns from federal government investment abroad, of funds belonging to some government agencies such as the Nigeria National Petroleum Corporation (NNPC) for financing its joint venture expenses for letters of credit opened on their behalf. These funds can be monetized anytime a mandate is received from the federal government. Sources of external reserves in Nigeria. Nigeria's external reserves are derived mainly from the proceeds of crude oil production and sales. Nigeria produces approximately 2 million barrels per day of crude oil in joint venture with some international oil companies, notably Shell, Mobil, and Chevron. Out of this, Nigeria sells a predetermined proportion directly, while the joint venture partners sell the rest. The joint venture partners pay petroleum profit tax to the federal government through the Federal Board of Inland Revenue. Nigeria's major foreign exchange reserves inflows are derived from the oil sources. This constitutes more than 90% of the country's sources of external reserves, as shown in Figure 12.3. This includes revenue from the following sources: proceeds from the sales of Nigerian crude oil equity, in which the Nigerian National Petroleum Corporation (NNPC) has the responsibility for the sale received; royalties funds paid by oil companies to the nation arising from the commercial exploitation of Nigeria's oil resources, which the Petroleum Act of 1969 provides a percentage to be paid as royalty on the chargeable value of the crude oil petroleum spirit production in a particular period; penalty for gas flaring, rentals, and signature bonuses; and finally, petroleum profit tax and receipts from gas sales. Oil companies pay tax on profits arising from their operations. A tax rate of 85% was specified by the Petroleum Profit Tax Act. Other sources of external reserves in Nigeria, among others, include income from investing foreign reserves, interest on wholesale Dutch auction system (WDAS) account held by deposit money banks, inward money transfer and value-added tax (VAT), education tax and commission. Trends of external reserves in Nigeria. As observed from figures 12.4 below, the external reserve stock of the country stood at a mediocre position of $0.15 billion in 1970. Since the 1970s, the Nigerian economy has persistently depended on oil as the main source of foreign exchange earnings, with the attendant cycles of economic booms and busts. Prior to the oil windfall of 1974, reserves averaged $0.25 billion or 1.9 months of import cover. Opulence from the oil boom sharply swung reserves position to an average of $5.2 billion or 8.24 months of import cover between 1974 and 1980, with the highest stock of $9.97 billion in 1980. This rise was attributed to the loans contracted in 1978, the increased oil revenue receipt of the last 2 years of the decade, as well as the import austerity measures of 1979. Following the sharp fall in the price of international crude oil, the hamstringed domestic industrial production and poor performance of the non-oil export intense pressure was brought to bear on the reserve stock, leading to a phenomenal depletion to $0.072 billion or 1.8 months of import cover in 1988. The stock of reserves revolved around an average of $2.1 billion between 1981 and 1995, except for 1991, when it rose to a decade high of $4.45 billion. The poor trend in reserves build-up during this segment was largely attributed to weakening international oil prices, substantial increase in aggregate domestic demand pressures, external debt overhang and its interest payment, deteriorating terms of trade, and so on. The level of external reserves maintained a sustained rise thereafter, albeit with some fluctuation in 1999. Reserve stock rose from an average of $3.21 billion between 1989 and 1996 to a significant $11.9 billion in 1997, representing an increase of about 271.6%, though it declined to $5.9 billion in 1999. It however recovered to $10.7 billion in 2000, but fluctuated downward to $7.7 billion in 2002. Since then, reserves position had risen astronomically to $17.0 billion or 13.6 months of import cover and $42.3 billion or 28.4 months of import cover in 2004 and 2006 respectively, and then to international banks and lending risks. International banks are faced with many risks when they want to lend to intending borrowing countries. Three important risks faced by international banks include credit risk, currency risk, and country risk. Credit risk. Credit risk that banks face is similar to the one faced by national banks. The risk is the fear of whether the borrower will pay back the interest, talk less of the amount of the loan. However, international banks tend not to understand the economic situation of the borrowing firm or individual. Even if it intends to know, it may be costly, and of course, the reliability of such information is doubtful. For example, it is easy for GTB to understand and predict the creditworthiness of a firm willing to borrow from the bank, but it will be relatively difficult for Citibank of the US to predict the creditworthiness of the Nigerian firm. For Citibank and other foreign banks to do this, the government must provide convincing assurance for adequate and proper repayment of the loan. Currency risk. One risk that an international banks face which is not faced by domestic banks is the currency risk. This risk is high in a country where forward exchange rate is weak or non-existing, or a country with floating exchange rate. The currency risk has to do with the depreciation or appreciation of the borrowed currency. For example, if Nigerian borrows pound in the US bank and if the pound depreciates against dollar during the period of the loan, the repayment will lose value. But if the pound appreciates, then the repayment will increase in value. Since the lending bank is uncertain as to what exchange rate will be during maturity period, the bank would prefer to lend to firms from a country where the forward exchange rate is effective or where exchange rate can be predictable. Meanwhile, if the bank is a credit lover, it can offer loan to the firm. Country risk. International lending banks also face country risk. This risk is related to the political development in the borrowing countries. Some countries encourage borrowing from other countries to improve on economic development, while some countries will discourage it for the fear of claiming the sovereignty by the lending country. Generally, international lending banks must evaluate credit risk, currency risk, and country risk before taking decision on how much to lend and for whom. When such decision is expensive, perhaps due to unreliable information about the borrowing country, reports and statistical indicators may help determine the lending risk they have to face. Summary of Studies section. The purpose of holding reserve is to enable countries fill the gap between time of earning and time of spending. Deficit nations can use reserve to correct balance of payments temporarily before major policy is taken. Determination of reserve depends on the monetary value of international transactions and by the size and duration of balance of payments disequilibrium. When a country is operating under floating exchange rate, there is no need for demanding for reserve because the disequilibrium will correct itself but at the expense of weak or strong currency. With fixed exchange rate, the nation needs to demand for reserve so as to maintain a predetermined exchange rate. Thus, there is an inverse relationship between demand for reserves and exchange rate flexibility. The demand for reserve also depends on the effectiveness and efficiency of international adjustment mechanism and efficient international policy coordination. The more effective, the less reserves are demanded for. The demand for reserve also depends on the effectiveness and efficiency of international adjustment mechanism and efficient international policy coordination. The more effective, the less reserves are demanded for. Supply of international reserves is of two types: owned reserve and borrowed reserve. Sources of owned reserves include foreign currency and gold and special drawing rights. Sources of borrowed reserves include IMF drawing arrangement, the general arrangement to borrow and the swap arrangement. When making international loan, lending banks face credit, country, and currency risk. This is the end of ECU 451. Thanks for listening.